So, good morning, good afternoon, or good evening, wherever you are in the world. Welcome to another edition of Psychology of a Fund Manager. And we're having blue skies, very cold, but blue skies in Munich, so the world seems to be a much better place. Markets have had a nice bounce, considering when we last spoke a week ago, when it seemed that there was potentially a lot of market manipulation, a lot of front running, should we say? But we'll see how that washes out. So today, I think I wanted to speak about the fact that I've been at one stage, I was a fund of fund investor and looked at hundreds of funds. And having had my own fund, and obviously you compare yourself to your peers, you kind of want to take a view as to what's the most important thing when selecting a fund manager, because everyone is smart. Everyone has the same sort of educational backgrounds. They're all, ex big banks, whether it's Deutsche, JP Morgan, Goldman's, etc. Everyone's done CFAs and MBAs. Everyone has Bloomberg's, everyone has research, everyone uses the same tools, give or take. So, what gives one fund a significant edge over another fund is what I believe to be as the French call it, a certain je ne sais quoi, the X factor, what you can't pinpoint. And that to me comes down to psychology, comes down to your internal narrative and also your belief. The challenge is when you're looking at it from the outside, raising capital is a bit about storytelling. It's hard to identify what exactly the key principles are for fund manager selection once you've excluded like the returns, the systems, their lovely offices, all those things and the fancy newsletters and the deck and what, put all of that aside. Anyone can build those data rooms, etc. What is then the core of what you're looking for? So you're looking for a fund manager that you believe will outperform given a risk adjusted return. So what are the parameters that you look for? So I would spend like maybe 20, 25, 30% of my time on the ops DD because crypto is a very difficult ops environment. You have difficulty in terms of chain of custody, authorization. You need to segregate responsibilities in a crypto business. It's not the custody is not the same as the equity space. But I would then spend about two-thirds of my time, if possible, on the managers, trying to understand the managers themselves, what makes them tick, how they think, going through it, come up with a trade from the genesis of the trade to the execution, how they feel about risk. And I kind of came up with what I believe are sort of almost four key principles in selecting fund managers. There's a fifth as well, but we'll talk about the first four because the first four are tangible. So the first one for me is you have to align your interests. So you have to make sure that there's no mismatch of expectations. Now, that means you need to have, obviously, there's a say, a manager must have skin in the game. One talks about skin in the game. Many emerging fund managers don't have enough money to call it have skin in the game. Their skin is the game. The fact that they like have a family to support and they don't actually have like this, millions in the bank, they're kind of relying on building a business. This is their boat. This is their life raft. Obviously, it's better if they have actual cash in the fund. But the fact that they've committed 100% of their life to this, because it's not a hobby. Managing money is not a job, a 9 to 5. It's like a lifestyle. You live, you breathe the markets. You spend all your time thinking about P&L, how to raise capital, and how to generate performance. So you need to align interest of the manager. But this is like, challenging to do given that, if a manager believes that his only way to make money or to build a sustainable business is to generate outsized returns, the problem is they start swinging for the fences, they take on way too much risk. Most fund managers have come to the realization, as I have, that being the leader in the pack kind of paints you up as a target, and being the worst means you get cold. So you want to kind of be in the middle. And is that the right way to think about managing money? To want to just aim for like sustainable, middle of the market sort of returns? I don't know. Personally, I liked early stage alpha. I wanted managers that were reasonably young in their business, building their business, not their age, but young in terms of building the business. Kind of had started going through that J curve, was starting to see a bit of light on there, and they were very hungry, very passionate, and they hadn't made so much money that all they were now doing is defending their business models. Once funds get big, the incentive's not to swing the bat. The incentive's to defend your business model and just block the ball, kick it into touch, as they say, and just generate some nice management fees and maybe a little bit of performance fees, and continue like building a team around you and this moat of people that protects you from like real like in insight. a lot of managers become unavailable once they get to a certain size. So you need to make your alignment of both your interests a key principle. Um, if career risk or self-interest is the biggest influence on a manager's decision, then I don't think they're an investment professional. And that means it's important for managers to be able to generate enough seed capital and enough investment into, let's say, the GP, that they have a 3-year runway, because that's the runway you need. You need 3 years to build a business. With the tech you have today, you don't need lots of marketing people or analysts. You actually can build a much leaner business, but at the same time, you need to have alignment of interests. And that kind of leads me into the next point, which is when I was managing equity funds, and I'd spent time studying what I perceive are the better long-term investors, particularly in South Africa. Alan Gray was my favorite, known as a lead steer because he consistently had outperformed over the longer term, and there was the likes of Buffett and others. But what I liked about their mentality in terms of psychology was you need to think of investing as a long-term business owner. You're not just buying and trading something and selling, buying and selling a share, and then you talk to management and you drop it, and then no, you're like got to think is if I used to tell my analysts when I was trying to train them, if you had one investment, you were retiring and you could buy one share, one company, and that was it. You had no other optionality. Would you be buying a cyclical mining stock? Would you be buying a defensive retailer? Would you be buying a cash flow generating like British American Tobacco or Home and Personal Care, like a Unilever? What kind of company would you buy? Why would you buy it? And then, understand you're giving management your money. So it's like you want to be aligned with them. Now it's the same when running a fund. You have to think like a long-term business owner and not just look for some short-term gain. When you're buying shares, you're investing in a business for the long term. When investors are putting money into your fund, it's the same mentality. They're putting money away with you for the long term, not the next quarter, not the next year. When I'm trying, raising money for this Bitcoin compounding fund, and soon there'll be an Ethereum compounding fund and a Solana compounding fund, and then a macro compounding. So like this is just the beginning. We've really developed like the strategy, which is like catching lightning in a bottle. And I have to think long term and say, well, I want to build a proper business around this and build, proper yield products around it too, and then push them into emerging markets and so on. So I need investors that are like aligned with that long-term thinking and aren't going to say, as what happened in the last few weeks, oh, Bitcoin's dropped from 110 to 85. It's like, that's great. We're generating more yield. Incidentally, the market's down like close to 15%. We're down like 6, and we've generated 3% more Bitcoin. And hopefully the market sells back off and I can generate more. And if it rallies back to 100, I'll keep generating. So that's kind of the thinking is like, are you aligned with your investors? As you're looking for a fund manager, I used to give money to funds, particularly in the crypto space, and say to them, I have a 3-year view. That's the cycle. So I'm not going to take the money away for 3 years unless you do something really stupid or there's like a big disruption in the firm's management. But you have to align yourself for the longer term. What is the long term in terms of fund management? Well, that's the challenge because in a market that's become increasingly quite quick in terms of its turnover, and we'll get to the AI perspective now. I think the long term seems to have been truncated from like a 10-year relationship to less than a 5-year relationship. And the reality is, good things take time. You underestimate what you can do in 10 years, but you overestimate what you can do in one. So good fund managers need to be given a decent amount of rope, a decent amount of funding, not made to do the whole like, yeah, it's a startup, so we're gonna make you like suffer on like, sub living. Like it doesn't help you. You don't sit there going, oh, I feel great about myself and I'm hungry. No, you sit there thinking about, should I be doing this? Should I go and get a job? And that's what I always watch for. Fund managers thinking about the business or thinking about performance. Because if they're working in the business and not on the business, it's not gonna unfortunately work. Because as the saying goes, when financial stress or poverty comes to the front door, then love kind of jumps out the window, right? So the business partnership's going under immense strain if both partners are struggling financially. The other thing that I looked for, a third thing, was overconfidence in managers, but also so how they avoided that, but also having to accept uncertainty. And I would speak to managers and say, what is your reasonable expectation for long-term returns for your fund? And when they started talking like big numbers, I'd be like, okay, you're very much missing the fact that there's a reversion to mean, and supernormal returns will always be, pushed away, will always be traded away. Taking into account things like, growth in the industry and all of that is wonderful, but 25% compounded per annum forever is just not really achievable over the longer term. I think high growth industries can be good for investments, but it tends to be, as you can see in the crypto space, like, some of the easier money's been made. It becomes a bit more crowded. I think the practical implications of this is number one, managers' expectations of what they're capable of achieving. There can't be a mismatch between what you're looking for and what they're offering. So as I always say, the label on the tin must match what's inside the tin. If I would combine a fund having both low, medium, and high volatility funds, and I'd say if your beta drifts or your style drifts, it's a problem because then the fund can outperform and it might look good, but it's problematic for me because it's no longer playing out as I expected. And it kind of brings me to the kind of fourth point, which is consensus. A good fund manager is independent and objective, and they oppose consensus. So in that case, I remember going short on construction stocks way before the peak of the cycle. It turned out to be the right trade, but the problem is you look quite silly while it keeps going up, and the margins improve in the company, and the cash flow, and the dividends, and everything, and the earnings keep going up, and the multiplier expands. So there's that like whammy double effect. If it wasn't for the 2008 financial crisis, I don't think those companies would have actually been come back as shorts back in 2000 and into 2008. So I think you need to understand what the consensus is. And the consensus was initially these construction companies were the great place to hide. And then the consensus was they're all shorts because they're running into big problems on their projects. But it's difficult to avoid consensus when consensus is something that's unknown. So before it was like small banks, then there was the mining boom, then there was the construction. These are companies that were known. Even social media to an extent was understood and known, like Netflix. They weren't complicated business models. AI is complicated. AI is like way more complicated than any of us really understand. It truly worries me in that I don't think we can coexist as peacefully as we would like to believe with AI, which is becoming increasingly self-aware. But putting that aside and putting aside what potentially could become, quite a big problem for us down the line, which, as most people do, they kick the can down the line and say, well, we'll deal with it then. But then then could be a bit more challenging to deal with. So going back to the consensus, I believe that what AI is trying to do essentially is that it's trying to replace every kind of human decision, right? The goal of AI is to automate all human cognitive behavior. That's what Watson did. That's what Ali Alibaba, was it not Alibaba? Was it the BlackRock algo did? It is Alibaba, yeah. And when you think about it, it's like everything your brain does, they're racing to replace. Okay, so it's every marketing job, every coding job, every accounting, finance, legal, etc. So, the problem I have with AI at the moment, and it's just a slight divergence, is when I look at the companies, they're using it's almost like Enron style, debt, all sitting in SPVs off balance sheet to do this. So the US is just throwing as much money as it can to be the Super League because whoever's first is like going to win and everyone else is going to be nowhere. And I don't know once you get to AGI, like what that means. What I do know is that that's the consensus that all jobs are going to be gone. Elon Musk is talking about robots that are going to be better surgeons than doctors, and I get it. Like there's going to be a lot of replacement, which there already has a lot of displaced jobs. The people running it, and there's like eight of them in the world, are not too concerned about this, and that's a whole other ethical discussion. But the consensus is that this is going to happen, and my view is, well, actually, no, it's not. My view is that pretty soon they're going to start hitting some serious, serious challenges and obstacles because they rely essentially on the replacement of people to do people's jobs. And if there's no demand for some of those jobs going forward, how does that play out? I think what you're looking for in terms of good fund managers, therefore, is fund managers that look at the opposite side of a problem. When everybody's kind of looking at it like this, you need to force yourself to turn your head that way and say, what if? What if? Whenever I look at a company or when I look at Bitcoin, when I look at anything, I have two pieces of paper and I sit and I write down the extrapolation for good and I write down the extrapolation for bad. And I say, what if this? And I try and draw like a tree and say, extrapolate as many years out. What could be good about this and extrapolate many years out as what could be bad. And then using that mosaic theory they speak about, put the pieces into a puzzle and go, well, this is the overall picture it paints. The overall picture that AI paints is one of not a great future for many people in terms of skills. What it does paint is obviously a better way of doing things depending on who's controlling it. And I don't think anyone's able to control it. As fund managers, everyone's kind of riding this bubble and saying, oh, it's just the good's going to get better and the better's going to get better and we can keep going up. And I understand that it's a reasonably unknown technology. But what I do know is there's nothing new under the sun. Nothing. And the hens always come home to roost. And there's the most powerful force in the market, if you understand psychology, is a reversion to mean, because reversion to mean is also how people behave. They have a reversion to their base, to their mean behavior, to who they really are. They can try and push away, but as the saying goes, a leopard doesn't change its spots. And when people, hold themselves up as something that's not real, as they said in The Godfather, power wears out those who don't have it. And that's the reality. You need to then understand, if you're a real fund manager, what a real fund manager looks like. And what is the psychology of a real fund manager? Well, there's all these terms just cold, and next week it's cold and raining, so you just dress accordingly. And next week it'll be nice and sunny as it is today in Munich. So I think that's the key takeaways for me in terms of how to align with your fund manager. Do they think of it in terms of a long-term business? Is their psychology sound in terms of who they're partnering with? Most important, like any other marriage, a house divided cannot stand. So they need to be, aligned. They don't need to be doing the same job. The right number of CIOs is odd, and the number is one, as I've discovered quite a few times in my career. And too many cooks do spoil the broth, particularly when the cooks are amateurs. But the most important thing I'd say is the consensus, to avoid consensus. Consensus is great when you're on the way up, but be careful of the whiplash on the way down. And that's why I still stand very firmly against the consensus that Bitcoin is continuing to grow, continuing to become adopted. I'll go through the reasons in the market commentary on Monday. So I'll leave you on that good note. Have a good weekend. I'm sure next week we'll be talking about Bitcoin trying to break the $100,000 barrier, doing a couple of mock charges before it gets through. And I do believe one day, I don't know when, I'm not in the habit of predicting the time frame, but I do believe one day Bitcoin will cross 100,000 and never cross back under it again. When that happens, let's see how the consensus thinks. So have a good weekend, and we'll chat soon. Cheers.